Hi, I'm Raj Nalari, and it is my pleasure to talk today about Revolt Against Big. The discussion I would like to present today revolves around the problems created by large sized entities in economics, particularly which are powerful economically and politically powerful. What are the implications of large companies, large entities, and what are the possible options to deal with these large entities? I'll start with the first one, which is too big to fail institutions. Too big to fail financial institutions brought down the US economy in 2008 and almost created major problems for the world economy. For example, about $20 trillion worth of wealth was lost as the big financial institutions created problems. These concentrated and systematically important institutions, for example, AIG, Lehman Brothers, Bears and Stearns, and the ones that were bailed out by the US government are some of the things that I have in mind when I say too big to fail financial institutions. Now, after the crisis and after the bailout, the irony of the situation is that there are fewer financial institutions than before. And clearly, this is a situation even in Europe. The situation is the same because the big institutions tend to be destabilizing both the financial economies as well as the stock markets. For example, every 2 weeks in US you have a crisis, and if you look deeper, it's triggered by big banks and big entities. Particularly if the Austrian and the Italian banks have difficulty, there will be a lot of further problems in Europe. The second too big to fail institutions are also that you witness in terms of anger against big brother, that is the big governments. Events in Middle East, the way I would see it, are a revolt against the big man, that is big dictators and autocrats controlling the economic and political life for a long period of time. Anger in the US, for example, against the bailouts of not only banks but General Motors, Chrysler, and so on, even though it protected millions of jobs, is still the citizens at large felt that it was a case of too much excess of government intervention. The Tea Party, for example, came out of this anger against the US government. Similarly, in developing countries, you witness in the recent years a lot of anger against big conglomerates which are politically and economically very powerful. For example, you see revolt in a lot of countries, developing countries, where the informal sector is rising. It forms 30 to 50% of GDP in a lot of countries, and they want to avoid the big interventionist governments and not pay taxes, avoid taxes, because they're not getting any services from the government. And I see that as a part of a big government. Then similarly, we have big oil still rules. There are very few times that the world sees the big oil as a threat, but you see that in the volatility of the oil prices, for example. Most of the petroleum and natural gas companies in the world are controlled by a few state-owned or state-owned companies. For example, in OPEC country, apart from the OPEC countries, there is Sinopec and Sinochem in China, which control most of the oil and natural gas. There's the Namcor in Namibia. There's the Hindustan Oil. Then there's the Pinig in Turkey, and so on. I can go on for a long time. These oil giants behave like second central banks in a lot of the countries. If you have worked in these countries, you find that the oil and energy ministries, the oil and energy companies are clearly not answerable to many in the countries, and they have so much foreign exchange and so much revenue that they can even be more powerful than the central banks. In China, for example, state-owned enterprises account for 30% of GDP, and clearly they are a dominant force in the Chinese economy. Similarly, if you look in the developing countries, there are large conglomerates that deal not only with financial institutions, but also these conglomerates are into media, they are into other industries, they are into hotels and so on. Let me give you an example. Sandals, which is a Jamaican-based tourist hotel business, has more revenues than the Central Bank of Jamaica coming in, and it can control the Jamaican economy. Sandals can control the Jamaican economy much better than the central bank. There are also production sharing and trading firms which are quite large, for example, in East Asia. And one of the reasons for major truncation in the trade during the late 2008 global crisis was because of these production sharing big trading firms. When one of them is affected, they bring down a whole host of other smaller firms as well as economies. So the advantage of having these big conglomerates and big institutions is that they have the luxury of getting a lot of resources, financial resources. The cost of capital is very low, and they can avoid a lot of taxes, avoid transparency, public scrutiny, and so on. So that's the advantage of big conglomerates. But there are a lot of downsides as far as policy making is concerned. Particularly, there's growing pressure from people via social media to deal with these monsters. These monsters, whether they are in media, whether they are in government, whether they are in financial institutions, and so on. That's the essence of the argument. So how do you deal with these big institutions? So for generations, we've been trying to deal with them without much success. These institutions pose systemic risk. In other words, the failure of one institution can bring down a whole economy. For example, in 2008, the Satyam computers, which was a large computer industry which was spread over in many countries, collapsed for fraudulent reasons, because there was no scrutiny and because they were not transparent. As the president of Satyam Computers then said, it was like riding a tiger. Once they did some fraudulent practices, they could not then unwind these fraudulent practices. And at the end, it cost the government of India quite a lot to bail them out and to protect the employment. So this is the major problem, that the failure of one or a few such institutions can disrupt the economy for many, many years. For example, the US is struggling because of a few financial firms' misbehavior. And if so, the governments will have to deal with that problem, even though the cost to taxpayers will be high, because the governments have to deal with the economic impact of these. So one policy option, for example, that has been tried is preemptive nationalization, say of the large banks, of large industry, large media. But in 21st century, this is a terrible idea, because the governments cannot manage these technical and economic entities. It will be very hard for the government, for example, to manage banks and so on. The second option is, should regulations be instituted to prevent such institutions to become too big to fail? That's a question that you may want to consider. The third option is, should they be broken up? There's an argument in economics that infrastructure companies have to be quite big. These are called natural monopolies. But still, in 21st century, given the technology, for example, there is no need for such natural monopolies. AT&T, which used to be called Ma Bell in US, was broken up some 15, 20 years ago. And because that was broken up, newer companies such as Sprint, Verizon, Vonage, and so on have come to play. And so now there is increased competition. So even companies that deal with infrastructure can be broken up if it is done rightfully. They have to be specially regulated. One option is, should they be specially regulated, especially by a single regulator that assesses all these risks of all the entities? because these conglomerates, because these financial institutions are into insurance, into banking, into investment banking, into media and this and that, the point is that they are spreading the risk all across the economy. So should they be regulated by one special regulator that is created just to deal with that? That is one of the lessons of the financial crisis. For example, AIG was an insurance company but also dealing with other things. Should they have been regulated by one big regulator? Some degree of additional regulatory costs. For example, BIS is suggesting, Bank for International Settlements in Basel is suggesting that these too big to fail institutions should have higher capital requirements, and that will make them more disciplined. But again, this is an argument that has to be tested. The third one is whether government should enact improved resolution procedures for systematically important firms. For example, should they have to issue a long-term debt which automatically converts to equity under specific conditions? The point here being that these large financial institutions, these large entities, when they're bailed out, their capital is still protected, their salaries are still protected, and their management is not taking any losses. So the idea there is to give the private sector a haircut, or they should lose some money when they mismanage these institutions. And that's the idea behind how debt should be converted to equity after the crisis, particularly, so that the cost to the taxpayer is minimal. But again, this has to be tested out. And finally, the issue of to improve the process for orderly resolving the institution that is failing to be put in receivership, to use the judicial process, to use other processes so that they can be managed to be unwound in a systematic way, so that the cost to the society is again minimal. These are some of the options that are now being discussed. There are a lot more issues which we can go into detail.